and individual goal, they differ to each other. Organization goal are different and personal goal are different. And in order to bridge the gap between personal goal and organizational goal, that is why we need to study goal congruence. And in goal congruence, there are some formal control system in which the control systems are developed by organization, installed by organization. And in control system, company, they are taking help of technology. Company, even they are taking help of management principles. So with the help of management principles, with the help of some financial techniques and technology, organization follows formal control system. Like say in most of the companies, computer where passwords are there. So through password, the person is identified whether he is authorized person or unauthorized person. Secondly, CCTV. So CCTVs are installed so that we can observe the movement of worker and employee, how they are behaving at a workplace. So they are moving around from one place to another place, whether they are concentrating on their job or they are chit-chatting or doing some time pass at workplace. So such things can be disclosed through CCTV. And then security. So that is a traditional system which everybody aware. At the entrance of a company, securities are appointed. So security, they check whether the person is authorized or unauthorized. Unauthorized person will not be given permission unless and until they get permission from company. So they will have to, in support, they will have to prove, they will have to produce permission later, and then only entry is given. So that is security. So these are all formal group. And then in case of product, company, they prepare manual. So along with the product, manuals are supplied to the customer so that customers are supposed to observe that manual. And if they are not following the manual, then it will not be a responsibility of company. And this way, company reduces loss in regards to the product. So this point we covered in goal congruence. Am I correct? Hello? Do you remember these points we covered yesterday?
Yes, sir.
Now, today we are covering transfer pricing. What is the topic? Yes, what is the topic? Transfer pricing.
Transfer pricing.
Transfer pricing. See, look at here. Transfer pricing is the topic for today's discussion. Now let us know about transfer pricing in a decentralized profit center. What do we mean by decentralized? What is centralized and what is decentralized? Are they same or different?
Sir, different.
Different. Centralized means at a one place, that is centralized, and decentralized means at a different location. At a different location. So company is in India, but in India they have different locations. Maybe in Maharashtra, Tamil Nadu, Kerala, Gujarat, and so on. So this is called as a decentralized. So in a decentralized profit center, we have learned in responsibility center. There is investment center, profit center, revenue center. So in a decentralized profit center, the monetary value at which transfer of goods and services from one profit center to another profit center is accounted for the evaluation on performance of profit center is termed as transfer pricing. Now, let me tell you. Now, suppose there is company called as XYZ company. Now XYZ company has two divisions. division A and division B. What is the company name? Hello? What is the company name? XYZ. And XYZ has two division, A division and B division. Now here, when A division sells goods to B, B is also belongs to XYZ company and A also belongs to XYZ company. But between A and B, there are transactions. So when A sells goods to B, then at what price they should transfer from A to B? That is known as transfer price. So that whatever profit expected by A will be with A manager, and the price which is paid by B manager. So B manager will see that at what price outside the goods are available, and if they purchase goods from their own division, A division, at what price they should purchase. So that freedom is given to the B manager. So XYZ is the company where A division belongs to XYZ. Similarly, B also belongs to XYZ company. So here, monetary value at which transfer of goods and services from one profit center. This is one profit center from A to B. Another profit center is accounted for the evaluation performance of profit center. It is termed as transfer pricing. Now, if you understood, can you tell me the meaning of transfer pricing? What you understood? What do you mean by transfer pricing? Yes, any one of you? Yes, can you tell me the meaning of transfer pricing if you understood? Can you hear me? Hello? Hello? Am I audible?
Yes, sir, we can hear.
So can you tell me the meaning of transfer pricing with this example and lines? Sang bara मला the meaning of transfer pricing. Yes.
Sir, I think it's like the transaction we can consider as a practice to extend the border transaction, like the domestic ones.
Yeah, it is domestic one. Between the division. Suppose now, as I told you, there is one company. One company is having two division, A division and B division. Both division belongs to that company. So when A division transfer their goods to B division, so this is known as transfer pricing. It is between the two division of same company. Getting it? Hello? Are you getting this?
Yes, sir.
So the value at which transfer of goods from one profit center to another profit center is accounted for the evaluation of performance of profit center is termed as transfer pricing. Now, what are the objectives of profit center? Now, before we go to the objective, anything you want to know about this introduction or meaning part? Anything extra information you want about meaning of profit center? When the goods are transferred from one profit center to another profit center, that is called transfer pricing.
Yes, sir.
Any doubt?
No, sir.
A doubt? Okay. Now let's go to the next slide. That is objective. Now these are the objectives. Now I request everyone, please go through the objectives. I am giving you 2 minutes and then we will discuss about this. Okay. Everyone read
Okay,
this
sir.
only.
Yes, sir.
Hope that you have gone through these objective lines of transfer pricing. What are the objectives of transfer pricing? So objective number one, to maintain optimum trade-off between company cost and revenue. So that company cost should be minimum and the revenue should be maximum. That trade-off should be maintained, and that is the very purpose of transfer pricing. Because though the divisions are belong to the same company, but one division should also able to enjoy their revenue. At the same time, the other division where the goods are burdened for another division. So that kind of thing, which is the very first objective of transfer pricing. Optimum trade-off between company cost and revenue. And what do you mean by trade-off? Trade-off means cost should be minimum and revenue should be maximum. That is trade-off. Second, we should reduce goal congruent decision. As I told you at the beginning of session, what is goal congruent? Goal congruent where corporate objective and personal objective, they are different, but at the same time that gap should be bridged. So we should use goal congruent decision. Third objective is to measure economic performance of individual profit center. So what economic performance is, whatever raw material is available with the profit center, and the other profit center which is in the requirement of a particular thing. So when first transfer goods to another profit center, so they should achieve economic performance. Both division, they should economic should be achieved by both the divisions. And the last objective, it should be simple to understand and easy to administer. If it is too much complicated transfer pricing, then it also becomes difficult for manager to implement that transfer pricing. So, reduction possible. It should be easy to understand at the manager level. Now, after understanding the objective of transfer pricing, let's understand fundamental principle of transfer pricing. Now, this is the fundamental principle of transfer pricing. See my PPT? Hello, everyone. Can you see my PPT?
Yes, sir.
Now, transfer pricing. Transfer price should be similar to the price that would be charged if the product were sold to outside customer or purchased from outside vendor. Now, what does it mean? Let me give the example. Now, suppose assume that there is IT company, IBM company. IBM company wanting to provide transportation to their employees. Are you getting my example? Hello, everyone. Are you listening my example?
Yes, sir.
Say there is a IBM company. They wants to provide transportation facility to their employees from their residence to company location. Now there are two options available for IBM company. Either to have their own transportation arrangement. Now, if they are having their own transportation arrangement, then they will have to purchase buses for transportation. Then they will have to hire driver. They will have to appoint mechanic to maintain their buses. Now, purchase of bus, appointing driver, appointing mechanic, the staff. So the cost is involved. Now, there is another option available for IBM company. Instead of purchasing this bus and making appointment of driver and cleaner, they can outsource buses from outside. IBM company can outsource buses from outside. And there are many vendors available in the market. who provides buses on a rental basis. Now here IBM company will see if we have our own buses, what would be the cost? And if you go for outside vendor uh, getting buses on a rental basis, what will be the rate on a yearly basis? And then they will compare. Now suppose if they get buses from outside vendor and if charges are more, naturally this decision will not be accepted. Vice versa, having their own buses, if it is cheaper than getting buses on a rental basis from outside, if it is the fundamental price should be similar to the price that would be charged if the product is sold to outside customer or purchased from outside vendor. So here IBM company is which option is economical, whether to have own buses economical or get buses on a rental basis is economical. That decision will be considered. So this is the principle of transfer pricing. That doesn't mean that both the division belongs to the same company. So unnecessarily they should be charged at a high price to B division. That should not happen, because B should be given freedom. If it is not feasible, then purchase from outside. They should not purchase from their own division, that is A division. Now, the theory of transfer pricing. Now, let us understand what are the various types of transfer pricing. Various types of transfer pricing. Discussing the types of transfer pricing. But before we move to the types of transfer pricing, just now we discussed objective and fundamental principle. Any doubt in regards to the objective and principles of transfer pricing? Any
No, sir.
anything you would like to know about fundamental principle and objective of transfer pricing? Any doubt?
No, sir.
Okay. So into the types of transfer pricing, the first type of transfer pricing, that is market price. Types of market. What is market price? It refers to a price in an intermediate market between independent buyer and seller. As you see in the market, there are buyer and seller are there. Electric vehicle, two-wheeler. Now, who are the seller of electric two-wheeler? Can you hear me? Hello, can you hear me? Hello, hello, am I audible?
Yes, sir.
Hello. So which company is there who is selling electric vehicle in the market? Ola is one. Any other company other than Ola? Huh? माझा आवाज येतो का तुम्हाला? Am I audible? Hello, am I audible? माझा आवाज येतोय का?
Yes, sir.
Hello. So Ola is a company who is selling electric vehicle. Now Bajaj is also another company. Bajaj is also selling electric vehicle. And seller like you were interested in purchase of electric vehicle. So now in market there are several sellers who are selling, and there are many buyers who are wishing to buy electric vehicle. And every company is charging price to that particular electric vehicle. Or all companies are charging. Prices are different or same? Yes. Prices are different or same? I am asking you. Electric vehicle prices are same or different? Which are charged by the company? Naturally, prices are different. Every company have their own pricing structure, and accordingly they are selling in the market. Now here it represents true opportunity cost and provides incentive for effective production. Efficient production, sorry, not effective. It provides incentive for efficient production. Now company who is designing a proper electric vehicle for them, there is also incentive for efficient production. Now incentive for electric vehicle. Now government is giving some concession to the customer if they wish to purchase electric vehicle from particular company. From government side, government is allowing some concession on the total price. So why government is allowing concession? Because they want to ensure pollution free vehicle. There should not be pollution in future, because day by day pollution is increasing, and again petrol and diesel prices are also getting increased. So to avoid this situation, that is why government is giving incentive. Is government is giving incentive or not on a electric vehicle? Government is giving concession incentive or not? माहिती का तुम्हाला? On a price, government is giving concession incentive to customer. If you purchase electric vehicle, government is giving incentive, because government objective is to expand market. And that is why if you are purchasing car or if you are purchasing two-wheeler, incentive is offered from government side, giving incentive to the customer. Here, why government is losing their money? So here there is opportunity cost for the government. What is the opportunity cost? Because of if people purchase more and more electric vehicle, then there will be less pollution. Pollution will be controlled. Now, if more and more vehicle increases, diesel and petrol vehicle increases, then there will be more pollution. Again, for pollution, government will have to give solution in order to reduce pollution. Now, giving solution, again, there is a cost involved. So that is why government is giving concession to the customer for purchase of electric car or electric two-wheeler. Now here, the opportunity cost for government is government is sacrificing in order to maintain the environment. So for environment, this is the opportunity cost involved from the government side. Are you getting my example? समझते क्या example? Hello? Hello? The point is, it breaks down when there is excess capacity. So market price, when it goes down, if there is excess capacity, if too many things are available in the market, then what happens? Supply is more and demand is less. What happens? Prices increases or decreases? What do you think? When supply increases and demand decreases, in that case, prices increases or decreases? Hello?
Prices
Hello?
decreases.
Yes, prices decreases. So it breaks down when there is excess capacity. Prices decreases, so it breaks down. Now, so this was about market price. काय विचारायचं का market price बद्दल? Anything you would like to know about market price? Anything, any doubt? Or may I go to the next transfer price? May I go to the next transfer price?
Yes, sir.
Hello? Okay. Now, this is cost-based prices. Everyone, please read this properly. I am giving you 2 minutes time. Read this slide and then we'll discuss. Okay? Is it okay? I am giving you 2 minutes of time to read this slide and then we will discuss. Is it okay?
Yes,
Yes,
sir.
sir.
Hello? Cost-based prices, cost-based. It means when external market do not exist or are not available to the company, or information is about external market, prices is not readily available. म्हणजेच काय cost based prices means when there is only one company who is manufacturing a particular product and there is no other company in the market available, and even the customers are not aware that what should be the price of this particular product. In this situation, company follows cost based prices. Cost based prices means whatever cost they incur, on the basis of that they charge to their customer. That is known as cost based prices. When external market do not exist, when there is no external market available or are not available to the company, or information also is not available, what should be the price of this product. So in short, we can say monopoly business. Monopoly business means what? There is no competitor in the market. That is called as a monopoly. Are you getting me? Monopoly means when there is no competition, there is no competitor. That situation is called as monopoly. So in monopoly, what happens? Whatever company charges to the customer will have to pay that price. That is monopoly. Are you getting my example?
Yes, sir.
Now, below that, variable cost. Now, what is variable cost? Variable cost, it is the cost which varies according to the level of production. That is called as variable cost. Variable cost, it is the cost which varies according to the level of production. As you increase the production, variable cost you will have to pay. Like say, example of variable cost is material. Material is the example of variable cost. Now, let me give you, suppose if I ask you to prepare to manufacture one table, so whatever wood material required for one table, you should be provided. Now, suppose if I ask you to make 10 table, so you require more material or whatever material for one table. Within that one table, you can prepare 10 table. Can you answer me? The material which is given to you for making of one table, within that material, can you able to manufacture 10 table?
No, sir.
Can you able to manufacture? No. So variable cost. So because you are manufacturing 10 table, so you require more material. So this is an example of variable cost. That is why I told you it varies according to the level of production. If you are producing one thing, accordingly you require material. If you are producing 10 things, then you require that much material. If you are producing 100, then you require that much material. So 1, 10, 100, these are the level of production, and you require material accordingly. That is the example of variable cost. Second one is full cost plus profit margin. Now, what is full cost? Variable cost plus fixed cost. Fixed cost we know. Fixed cost which remains fixed at all level of operation, and variable cost which varies according to the level of production, and fixed cost which is fixed at all level of production. But variable cost varies, it changes, but fixed costs do not change, it remains fixed. Like say, can you give me the example of fixed cost? Anyone? Example of fixed cost? What is the example of fixed cost? Yes, please. Can you give me the example of fixed cost? Example of fixed cost is rent paid for building, whether you have full production or you have zero production. You have to pay rent to the landlord as decided between you and landlord. landlord will not reduce rent if you are not having production, or if you are having full production, landlord will not charge you more rent. The rent, same amount you will have to pay. So this is the example of fixed cost. Another example, license fee. License fee which is paid to the government. So government will collect the decided license fee, not above that or not less than that. So these are some example of fixed cost. So full cost means variable cost plus fixed cost. And in addition to this variable cost plus fixed cost, you have to add profit margin. Profit margin, maybe 20%, 30%, whatever profit margin decided by top management will be added. So that is known as full cost plus profit margin. So this is the another technique of cost-based prices. Third one is standard cost. Standard cost here, standard material, standard labor, profit. So this is the standard cost. Standard material, standard labor, this will be added, and on the basis of this addition, cost will be decided. So this is the example of standard cost. Opportunity cost. Opportunity cost, it is the cost which is forgone or sacrificed by owner. That is opportunity cost. Now, for example, if there is a Mr. A who wants to start a business, and to start his business, he requires 10 crores of rupees. Now, Mr. A has two options for his 10 crores of rupees. Either he can invest this 10 crores of rupees in business and earn 25% return from the business. Second option, invest this 10 crores of rupees in a mutual fund and earn 20% return. So investing in business, earning 25%. Investing in a mutual fund, earning 20% return. Now, if Mr. A decides to invest this amount into business and not in a mutual fund, so he is losing that money. He is sacrificing money which he is getting from mutual fund. Sorry. So this is the opportunity cost for a owner, not to invest in mutual fund, invest into business. So he is sacrificing 20% return from a mutual fund. So for his decision, opportunity cost is 20% because he is sacrificing, he is foregoing the income which he is supposed to receive from mutual fund. So this is about opportunity cost. So in cost-based prices, we have discussed 4 approaches to the cost-based price. And cost-based price, it is the price when there is no competitor available in the market. Yours is the only company who is doing or who is producing that particular thing, which is called as a monopoly. So in monopoly business, whatever company decides, customer will have to pay. But how company decides its price? So these are the ways and means for deciding the price. That is to know the variable cost or full cost plus profit margin, or standard cost, which I told you. Standard cost is standard material, standard labor. Addition of that will be a standard cost or opportunity cost. So with these ways and means, with this logic, company can decide cost-based prices. So there are also different prices. Can you see my slide? What is this? Hello? Hello?
Yes, sir.
What is this?
Negotiated prices.
Yes, this is the third transfer price type, negotiated price. Negotiation means to negotiate with other person. That is negotiation, negotiated prices. It is a middle solution between market price and cost-based price. Just now we have discussed cost-based price and market price. So this negotiated price, it is the between market price and cost-based price. So it avoids mistrust and bad feelings. So here you get the opportunity to negotiate, to bargain about the product. So that bad feelings can be avoided. And mistrust is also avoided. And we can have a healthy relation between buyer and seller, so that negotiation take place. But it depends upon individual ability and skill to negotiate. That every person do not have that skill of negotiation skill. Some people, they are very good in negotiation, but some people, they are not good in negotiation. But to start with negotiation, you have to have a skill about market knowledge. You should have market knowledge. You should know the economic condition. You should also know about the product quality. Then only you can negotiate. If you do not have this knowledge, market knowledge, or about the product, then you may not be able to have a negotiation about that product. Am I correct? You need skill or not? Or without skill, you can have negotiation. Am I
Yes.
correct? So this was about negotiated price. Again, I repeat, negotiated price, it is the middle between market price and cost-based price. And here you should have a knowledge about the product and market. Then only we can have negotiation. Now, there are also another type of transfer pricing, but that we will discuss in the next session. Now today, how many types we have discussed? Can you tell me what are the types we discussed of transfer pricing? How many types? Now we are at the end of session. Quickly tell me how many types we have discussed today? Transfer pricing types. Answer me fast.
Three
How many
types.
types? 3 types. Yes, very, you are correct. And what are those 3 types? Number one. Cost-based price. Number 1. Correct? Cost-based price. Number 2. What is the second type? Market price. Second is market price. And third is negotiated price. So these 3 types of transfer pricing we have discussed. The remaining we will discuss in tomorrow's session. Okay?
Yes, sir.
Fine, then let's end our session. Thank you for attending session. Thank you.
Thank you, sir.